I met with Matt Weller and Job van der Voort, who's the CEO of Remote. Matt Weller is the CEO of Muse. And I was just struck by their ability to encompass both the vision and the minutiae. And I think that's what founders are able to do. And so there is an element in there that is quite extraordinary that we're looking for. They all are very, very comfortable being out of their comfort zone. They're all very comfortable knowing that they don't know everything. They're all very, very comfortable in, like, it's not just growth mindset, right? It's really active open-mindedness with a high degree of conviction. Whether they're the smartest, but I don't know, but they're bloody smart. They're for sure. High IQ, high EQ, huge amounts of resilience, huge amounts of kind of open-mindedness and kind of ability to learn.
This was their finest hour.
Tear down this wall.
It's more than just an alliance. This is a union of values.
Let's start acting.
This show is not investment advice, and the hosts of this episode may be invested in the funds and companies featured.
Welcome back, everyone, to the European VC podcast. Today, I have Stephen Millard with me. Stephen, welcome to the pod.
Thank you. I'm very pleased to be here, and thank you so much for inviting me.
Yeah, of course. I think it's about a year ago since we had Notion on last time. So great to have you with us.
Who was that?
It was your founding managing partner. We were talking about your latest fundraise.
The wonderful Mr. Chandler.
Yes, exactly. So let me start this by saying you've just written a big report, done a lot of research. Congratulations on that work.
Thank you.
Actually. So I was working through this with the use of AI, of course, as anyone would. And I wanted to just say, I got to give you a nod because you're one of those that are still creating content at a time where we're all just consuming content via big models. So making us all think who's going to produce the next eras of content.
You know why? Because I have to do it to learn. I think there's one thing consuming content through AI and simplifying and summarizing, but I've always found to synthesize things and to make sense of them, I need to do the work.
I actually think that makes a ton of sense. So obviously, to anyone that follow EUVC, we're quite rapid in our content production, which means I get to synthesize less than I wish. I get to consume a lot, but I really wish, because a few times where I do take the time to work and develop content from the ground up, really.
It's real work, Andreas. Yeah. It's like it has meaningful and impact way beyond just the production of it. We gain so much personally from doing that kind of work.
Because now this was the personal side of it. Stephen, maybe first give us a really quick intro on Notion to those that don't know, and then tell us afterwards what made you think that this report is relevant right now.
Sure. So Notion Capital, we're a London-based European, EU-denominated venture capital fund. We invest exclusively in business software, B2B SaaS. That's our pedigree. We've been investing in that space since 2009. The founders of Notion Capital founded one of the world's first SaaS companies, and I worked there as well. It was a company called Message Labs. Few of your listeners.
Good old days.
Good old days. Founded in 2000.
Yeah.
We really challenged ourselves to try and figure out what do we actually call this? But that business grew from kind of a zero standing start in 2000 to 150 million revenue, profitable, and was acquired by Symantec in 2008. When it was acquired, I think, which is quite funny when you think about the contrast, it was the second biggest SaaS company in the world, second to Salesforce. Well, so we like to say, and then you say, and there's Salesforce with like, I don't know, 30 billion in revenue.
Yeah.
So anyway, the founders of Message Labs came together, decided to invest in the next wave of, European SaaS companies. And 15 years later, we're investing out of our fifth venture fund. We're almost full life cycle. We have a very active, very early stage, predominantly focused on Series A. And we do some straight to opportunity stage, like Series B, Series C. We've invested in probably north of 200 European B2B software companies, some really notable companies we can talk about. And I think there's three things that really stand out, and they've always been true. One is we only do business software. We're all ex-entrepreneurs and operators, and we believe in delivering a lot of value and impact to our founders.
And to anyone that heard you talk a little bit about the last fundraise there, I dive quite deep with Stephen Chandler on that in the episode from a year ago. And there's a ton of learnings in there when it comes to fundraising, which I think that can, for anyone listening in, is really worthwhile, because Stephen speaks very bluntly, very openly, and actually also shares quite a few stats on your fundraise and the path from top of funnel to bottom of funnel and the duration that it actually takes for a big behemoth like you.
I have so much respect for those, the investment fundraising team. They really do an extraordinary job.
So I wanted to say, because it's not so often that you hear as many details from the big funds as Stephen shared in that one. So that's why I like really to reference that and send people there.
Thank you. And my job is post-investment. Yeah. So I run our value add team, which is basically, founders choose us because we're business software, ex-operators and entrepreneurs, and we deliver a lot of value. My job and my team, internal and external, is to deliver on that promise. So why this piece of work, right? It's very interesting that the single most important question we ask of founders, and founders should ask of themselves before raising money from venture capital, is, do I have a credible pathway to 100 million in revenue? Yeah. And not to say you're going to stop there, but let's just let's put a line in the sand. Can you see a pathway to doing that in less than 10 years? And no one really understands, well, one, the probability of that, two, the companies that have achieved it, three, the success, the lessons they've learned, the mistakes made along the way. And I just felt there was an extraordinary opportunity to lean into a topic that is critical for anybody going on this path. And what I unearthed when starting to dig and find is it's actually quite hard to find a lot of the companies, because revenue data is private. Even when I did find them, they didn't know who the other founders were. Yeah. And nobody really shared their kind of stories. And so I want to set out.
If I can just add a point to that, because this is exactly why we founded EUVC, right? We started on the venture side. Now we're doing a bit more on the founder side. At least that's in the works. But it's exactly that recognition that European-centric case studies, European-centric data is nowhere near where it is in the States. If you said the same thing about US firms or companies with around 100 million ARR that are privately listed, you have a whole list of podcasts with the founders, long articles diving into them, but we don't have that in Europe. So I think it's so important. I think it's so great that you do a report like this.
And I was inspired by some of the US VCs that I admire so much, and some of the operators there, but also inspired by the companies in our portfolio like Muse and Paddle and Go Cardless, because I learned so much from them. And I had the opportunity to sit alongside them in a very kind of informal, passive sort of way. We're minority investors, but we led the A's and the B's in all three of those companies. And so I'd had the opportunity to see that journey kind of play out. And then I wanted to really dive deeper into it. And that's kind of what led me, the same realization as you have, Andreas. This information doesn't exist.
Yeah, exactly. Okay, but then because I do think we should talk about some of the commonalities among the cloud champions and so on. But before we go there, let's touch on something that I've always been wanting to understand, your perspective on in Notion, and you're probably one of the best guys to do so, being that you're really working with the portfolio companies as the operating partner. And that question is, you initiate the report with finding 3 large insights from this new era of AI, and you're calling it the dawn of a new era. And the first insight is knowledge asymmetry has flipped. And then you have a graph in it that I don't even want to try and describe, because it's actually, at least to me, it's difficult to describe. But you have an inversion basically of the relationship that used to be between buyer and seller, where you had the buyer knowing less than the seller, to then now being in a situation where the buyer knows more than the seller.
Yeah.
Can you tell me about that learning and what that means for SaaS companies?
I've learned so much from Jacco van der Kooi over the years, who's the author of that section of the report. And for anybody who doesn't know them, you really should lean into Winning by Design's kind of models and insights and learnings. He's an extraordinary man. And I think he's what he's really tapping into here, and I think that this is a critical insight, is that, you know, if I sit down and think about, right, I'm going to buy some new software, and I can create a very simple, nowadays, simple construct in Perplexity to say, hey, I'm interested in 5 companies that do ABC. I want to know this, 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 and this. All of a sudden, I'm incredibly well informed. Now, what does that mean? Is that there's obviously profound implications in terms of how companies need to be discovered, but it means that it's going to be increasingly harder to sell, and it's going to be increasingly harder to keep customers unless, and I think this is to Jacco's point, is it's all got to be focused on outcome, and it's all got to be focused around kind of really delivering customer value. To every single one of these 23 companies are obsessed with customer impact and customer value. And that asymmetry has flipped. You know, I was selling software back in the 90s at Oracle. We had all the power and none of the risk. And so it's a very profoundly different kind of world that we now live in. You know, I still think the fundamental truism of SaaS, which is I win an ideal customer that I can keep and expand, remains absolutely central to every B2B software company, so whether in whatever form factor they operate. The way in which you're going to do that is going to be, I think, fundamentally different over the next 5 to 10 years.
Yeah, and can we tap a little bit into that? Because what I'm hearing is exactly that part, that you are going to a place where we definitely are more often buying outcomes than we're buying product specs and so on in the beginning. Can you explain to me a little bit about the consequences of this, the flip you're also seeing? Because when we're talking companies, you know, that are at the plus 100 million ARR stage, that means that they will typically have created their products pre this in the beginning, pre this wave, and now they're then changing their model to adapt to a new environment.
Well, I mean, there's so much kind of tied up in that. One is that, you know, every one of these companies needs to go through a kind of constant processes of reinvention. It's a bit like this the ship of Theseus. Have you heard about that? The myth of the ship of Theseus, when it sails around the world, and, you know, hundreds of years later, the hull's changed, and the crew is obviously different, the sails are different, the mast's different, but it's still the same ship. And I think there's a lovely quote from Ewan Blair, who's the CEO of Multiverse, where he talks about the realization that I'm building multiple businesses, not just one. So I think there is that constant process of reinvention, but that reinvention is like acute right now, really acute. I think there's a really interesting insight and takeaway from this for new founders, which is pace has always been really important in building enterprise software companies. And we looked at data for Europe and we looked at data for the US. And we went back, and we've done this twice, like going back almost 20 years. It seems to be true that if a company doesn't achieve 100 million revenue in less than 10 years, it becomes less likely, not more. When you think about that, you say, well, that doesn't make any sense. Well, it does make sense when you then...
It means that the company has plateaued.
They've plateaued, but why have they plateaued? Right? Why have they plateaued? They may have plateaued for, you know, fatigue and burnout, or kind of like the challenges of their investors or whatever it might be, but more likely competitive pressure, technological obsolescence. Because, you know, all of these companies, they will be thinking about this like 100%, but every company coming through needs to be thinking the same thing.
Can you tell me a bit about, or maybe some war stories here, about the challenges that the companies that you've worked with have had to overcome? to adapt to this AI wave?
I think all of them are constantly balancing the kind of, I talk in the report about the yin and yang, kind of like the opposites of like exploring and exploiting. And just one example. So in every single instance within any business, in any stage you're at, there's a trade-off between those two things. Something I can't exploit if I haven't explored.
Yeah.
And there's no point exploring if I don't exploit.
Yeah.
When I've figured out something that works, I want to exploit it until I see it doesn't. So you can never dial down the exploration. So every single one of those, when I talk to the team at Muse or the team at Paddle, they are all constantly challenging themselves to say, actually, we're not optimizing, because that assumes that nothing is going to change. We're kind of exploiting what works and then constantly challenging ourselves to reinvent. So they're all exploring the better use of AI to find better insights for customers, using AI to be able to support existing customers better, to allow themselves to become more and more productive. I think it is just software, right? But it's just the pace of it. And I don't think we should assume that any of those companies are sitting on their laurels.
It's very often that whenever we talk about Europe, we compare Europe to the US. And I kind of want to take the same thing, so to say, because there's a strong quote in the report where there's a founder that says scaling in Europe is almost 10 times harder due to our fragmented markets than it is to scale into 100 million ARR in the US. Can you tell me a bit about what's behind this and whether you agree with that statement and so on?
Yeah. Look, so when we were scaling Message Labs, you rapidly come to the realization that we need to be a global player to achieve our ambitions, and we needed to expand across. Do we expand across Europe, or do we expand to the US? We actually took a very kind of pragmatic approach to say, for us, we believe a global business is UK, US, a foothold in Germany, and a foothold in Asia Pacific. And that's a global company, right? We went really big on the US, and in the end, that was the majority. It is incredibly hard for anybody to hit the kind of scale that companies in the US can do in Europe without addressing the US marketplace, for sure. The Europe is, and the EU and UK particularly, still pretty heterogeneous. And, the markets rapidly get a fair degree smaller. But interestingly, some of the companies in this group have done that incredibly well. I was talking to somebody the other day, and we're talking about US expansion. And actually, we used to get pulled a lot into that kind of conversation. I think most of them are just thinking global, not UK, US, or France, US. But it is certainly harder. But I think,
and when you say that, why is it possible? Why does it make sense to think global rather than UK and then US, or Germany and then US? What is the difference? What's the nuance behind saying that instead of?
Well, you've got very different buying behaviors and patterns across many of the European countries. And where there is homogeneity, they're pretty small. Whereas the US is a relatively homogeneous marketplace. Not entirely. You still have to make it kind of addressable and small. But if I'm a US founder, I don't need to go anywhere else if I want to be 100 million revenue business. Now, that doesn't mean that company is necessarily more resilient.
Well, but it is another part of the report, right? You say you have this point that European SaaS founders tend to a bit more grow with a long-term resilience rather than a blitz scaling framework or approach.
That is definitely an inference you could take. I think that's a relatively European. Is it a European mindset? I think. I don't think we really kind of bought into the blitz scaling.
It's a really interesting
mindset.
thing, right? So it's a constant discussion. We have it on the podcast here as well. To what extent do you in the US have larger ambitions? Do you focus on going larger, faster than we do here in Europe, or not. I kind of tend to say that the beautiful thing about Europe is that you can definitely in venture create great returns because our funds are smaller without as large outcomes. Generally. But then you also have the larger funds like Notion, where you automatically are put in a category where every single hit needs to be a really big hit.
Tell me about it.
And I guess that to you, Stephen, that's also why you don't like to think too much or describe Europe as being a bit more of a long-term resilience play rather than a blitzscaling play, because it does not work for your model at all.
And it's not about resilience versus blitzscaling. It's more about, for us, the fundamental definition of our category, right, is you shouldn't take money from us or from any other the big VCs like Axel, Alderton, etc., Index, etc. You should not be taking money if that's not the goal. That's not your ambition, if that's not your desire. And we shouldn't be going, it's a contract, right? That this is what we agree to do because our model depends upon it. And I think you can still unlock extraordinary growth in a very, very considered manner. And some of these companies have really done that.
And then tell me, Stephen, because I'm super curious, because you, by definition or by extension of what you just said, will automatically have worked with a ton of companies that when you come in are at this 10 million, 30 million ARR, and that is where many of them stall. So how do you as a VC help them unlock that next level of growth?
I mean,
what are the inflection
100%
points?
is the single most important thing, right? So we come in at less than $1 million in revenue. Okay. And what I like to try to say is, okay, look, we've invested in you because, we've mutually agreed that we're going to the moon. Like we're going to do hundreds of millions of revenue in the next 10 years. Let's talk about getting to 10. And that is a very, very different kind of set of challenges. And when you get to 10 and you start approaching it, we're going to start talking about the reinvention that you need to make to get to 30 million. And when you get to 30 million, guess what? There's another big chasm that opens up. And the data's not as robust, right? But I've tested and validated this with some USBCs, which is like fully 50 to 60% of the companies that raise a Series A will not get past 10 million revenue. It's just over and over again, because you can brute force your way to a pretty substantial business. And certainly we're seeing some companies doing that faster and faster. But if you think about the fundamental difference of doing anything and everything, whatever it takes, with an amazing generalist to get yourselves to 10 million versus, okay, now I need to bring in a whole raft of specialists. I need to scale up my sales team, my success team, my marketing team, my product and engineering. And so operationalizing that, we call it the build stage. So is critical. And that's where companies kind of stall, stagnate, or die. And that's not just us. It's not just Europe. It's global SaaS companies. That's it's called milestone. So we really lean into this.
A big one that you also describe in the report is the problem of finding talent that can really grow with the company, or the decision of, okay, now we need completely new talent at the entire executive level. Can you talk me through a bit how you think about that?
I'd probably start in a slightly different place, which is that there's a lovely quote from Christian Owens, who is the CEO of Paddle, and I've heard this so many times, right? That what gets me here won't get me there. Building businesses is a process of overcoming inflection points, like major critical changes. Some people call it as a plateau. What's been working will no longer work. And what and who made you successful? They may not be that they just don't make you successful going forward. They might lead directly to your failure. The concept of understanding that actually I need to think about this business in an entirely different way, and I need to adapt. And if you think about adaptation and survival and success, and this is a bit Darwinian, right?
Yeah.
It isn't necessarily the strongest and the smartest. It's those who are most adaptable. That word came out over and over and over again. Focus and adaptability. And so if you think about the founder, right? One of our CEO coaches calls it, sub 10 million, I'm the fearless warrior, like fighting every battle. When I get to 10 million, I actually need to take a different step and be more of a systems builder. She calls it a considered architect. And then when you get to 30, 40, 50, 100 million, I'm a monarch. I'm like leading a whole kind of raft of different kind of fiefdoms and divisions. That's a massive adaptation.
How do you work with founders to be able to go through that? Because most of us in venture are quite strong believers in founders and the importance that founders stay at the helm.
Oh, 100%.
But going from that first, the fearless warrior, to then being someone who is a bit more considerate, to all the way in the end being a monarch managing the fiefdoms, those are very big changes
very, very
in how
different.
you need to adapt and think.
Yeah. And, the most important thing for us is just signaling that this is normal, right?
Yeah.
This is the reality of the journey that you need to go on. We did some research about 2 or 3 years ago, and we looked at the most successful SaaS IPOs of 2020, 2021, 2022. It's 25 companies. And in 75% of cases, the founding CEO is still the CEO today.
Yeah.
You think about the big tech companies, the founder is the CEO, right? There's a strong correlation there. So that's implicit. But everybody else is different. And so that founders need to adapt themselves. They need to adapt their team. They need to adapt their organization to the requirements of each stage of the business. Now, that might be the same people. And we need to find a way to keep and retain the very, very best. But we also have to accept the fact that the challenges of starting, building, and scaling are profoundly different. And some of us are really good at all three. And I'm talking here more the operators, not the founder. Founder is, as far as we're concerned, that's immutable, right? They're the founder, they're the CEO. We want them there. They need to adapt. The leadership team is a bit more, needs to change. And the organization underneath it needs to change as well. So when you ask the question, well, how do you kind of just start leading the way, right? You just start explaining, this is what will happen. And these are the changes you'll need to make. Imagine yourself now, 10 people running the business. Imagine yourself in 10 years' time, 1,000 people in the business. How have you changed? You have changed, haven't you? You've adapted. Right. How have you adapted? Okay, let's talk about what that means and what it's going to look like. That doesn't mean that you're leaning into a huge kind of change program, but you recognize that need to adapt is critical. And I think that's one of the most important things, we can do for founders, is to give them the language to use for themselves and their teams around the kind of challenges of the businesses and success. And, I haven't done a study of those companies at the leadership level. I'd be amazed if many of them had the same senior leadership team as they had when they were 5 million in revenue. It was guaranteed it would be different. That's a good thing, right? Because what that means is, if I bring in a sales leader and I'm 10 million, and we often have this, I want someone to take me to 100 million. I'll say, no, let's get someone who'll get us to 30. Because that 10 to 30 is the hard yards. This is building on the frameworks, the systems, the process, the repeatability. If that person, when you're getting to 30, is still the right person to take you to 100, amazing. If not, hopefully we can repurpose that person into a different role. Maybe we send them, they go off to run the Americas or the APAC business. Maybe we just wrap our arms around them and say, Andreas, amazing, fully vested,
Yeah.
my love, go and do it again. And they come back and they do it again. And that's what drives real success. That continuity of people, where we're not taking people through and out of their comfort zone, we're actually allowing them to operate where they're very, very best.
Yeah. Can I ask you, Stephen, about the founder CEO? Just because you've done this study before, and I actually wasn't aware, but it's one that I think can all kind of puzzle us a little bit. Why it is that the founder talent is so important. I'm not trying to look at an individual company, but rather look at what is the reason here. Is it because of the standout talent in that one individual? Is it because of the dedication to the business and only the founder can really have that and what it's going to take? Is it because of them knowing the story of the company?
I wish I
That
knew.
mix of entrepreneurialism together with understanding of the sector and understanding of like, what do you see? Is it the confluence of all of these? And but are there any of them that you say the single most important thing is X?
A huge dose of kind of like conviction and belief with a huge dose of open-mindedness that says, I believe, but I don't know. And they're constantly challenging themselves to go out of their comfort zones. I met with Matt Weller and Job van der Voort, who's the CEO of Remote. Matt Weller is the CEO of Muse. And I was just struck by their ability to encompass both the vision and the minutiae. And I think that's what founders are able to do. And so there is an element in there that is quite extraordinary that we're looking for. They all are very, very comfortable being out of their comfort zone. They're all very comfortable knowing that they don't know everything. They're all very, very comfortable in, like, it's not just growth mindset, right? It's really active open-mindedness with a high degree of conviction. Whether they're the smartest, but I don't know, but they're bloody smart. Yeah, for sure. High IQ, high EQ, huge amounts of resilience, huge amounts of kind of open-mindedness and kind of ability to learn. What's interesting as well, it's a slightly different point, is that they're people who are very, very willing to trust their instincts. I didn't really think that was going to come out quite as strongly. It came up virtually in every single conversation. Now, one could say you're trusting your instincts because you've been doing this for 10 years and making these tough calls and making these hard decisions. So you're starting to learn, but they all talked about being counterintuitive, trusting their gut, going with their instincts, ignoring their VCs, and that came out quite strongly in a few of them, which is what you need to hear because we don't know how to build their businesses, whatever we might say, right? Yeah. So yeah, I wish I had a better answer, Andreas.
Well, I have a podcast because I'm such a student of people and individuals, and I think that there are just some superhumans walking around.
There are for sure. Yeah, they're not. I mean, it's the far extreme of the distribution curve.
Yeah, exactly.
They're down here, and so actually they're very hard to categorize.
Yeah, exactly, and that's the exact point. And I also think that these people exist on some type of, I don't know if we should call it continuum, but they are at different stages in life. The reason why you want a pre-seed founder to also be the person that ends up being the IPO founder, so to say, or the person managing the company at the IPO stage, is because it's not about what this person has seen and done and so on, but it's about the individual's traits.
About the journey they've been on.
And X number of people are created every year, born every year, that have this profile, and wherever they are in their life stage, that's, you want to hit them and then you want to back them.
Yeah, let's find them.
That's also why I think that, so when I say venture VC funds, that's also why I think a lot about large firms versus small firms. And I think a lot about, really, it's about the core partner team, and venture VC funds are so hard to scale. And you really need to have founders that, for whatever reason, have been able to build an investment company that scales their own potential, which I think by far the majority of people are not able to. So I think it's quite easy to, or not quite easy, but you can do a good VC fund that's small. Do a good VC funds that's big is very, very difficult, because I think that's where you need to have someone who has the same type of scalability or potential as a founder, because otherwise you'll just water down the talent that's up there, which will not be good.
Stephen Chandler is the most extraordinary person I've ever worked with.
Mm-hmm.
I think he was probably the most important person at Message Labs. He was the only person in the company who was in the same role from beginning to end, and he negotiated the exit and the acquisition as well. So you're right, and they are extraordinary. We talk about we're holding on to his coattails, and he's indulged us to allow him to go on the journey with him. I'm getting a little bit.
No. Well, I know
right?
you're. But I think that's exactly it. And I think that if that individual is not present, I think that both companies and VC funds are not that exciting.
There's a massive correlation between the presence of the founder and the long-term value. I am absolutely convinced about that. And it is one of those falsehoods that people think about, VCs. You get to a certain point, we'll replace the CEO. Honestly, just do the work. Yeah. That is not the case. And if you do that, you might get a reasonable outcome, but you're not going to get the exceptional outcome from doing that.
Can you tell me, what do you do when you realize that the founder's not, like, it's not going to work? The founder either decides that him herself, something happens, the founder, we can just see that the founder doesn't scale, so to say. Many angels would say, well, I come in and then we, and then they have the PE approach that they're going to replace. And we've just all learned that doesn't work.
Look, one of the things that's really important to recognize is that we're talking about outliers here, right? We're talking about the 1 in 100, right? In aggregate, that's pretty much what it is. Europe, US, around about the same, right? Mm-hmm. Bigger cohorts, but similar kind of outcomes. Because this stuff is really, really hard. That means 99% don't achieve that. Now, that doesn't mean that 99% can't have a great outcome. And so, as a venture investor, after 3, 4, 5 years, you pretty much have a sense, right? More than a sense, right, of which companies still could. Because sometimes, you take a company like Muse, 6 years to get to 2 million revenue, because it's a hard slog building that kind of capability for a hotel property management system. 6 years to get to 200, and probably another 6 years to get to 2 billion, I hope. But a lot can happen, further down the line. So, we work really hard to say, okay, it's not on that track. If you've protected the cap table and you've got a decent, solid business, and you can get it to a point where it's, more or less break even, growing 20, 30%, self-funding, 10 million, 20 million, 30 million of ARR, you can have a good life-changing outcome. So we shouldn't confuse the fact that we're talking about extreme outcomes with the fact that actually the reality is that's not the case in most instances. And that's been really good for us. And it's also been really good for the relationships we have with the founders, in that we have a good relationship with every founder we've invested in, whether they've had an amazing outcome or a decent or even a poor outcome.
Tell me, Stephen, how do you think about this? Maybe if we start by saying, let's look at it from the portfolio model perspective. What percentage of your final returns come from this bulk of companies that end up being decent outcomes? Is it the usual VC model that you've seen across the portfolio?
Yeah, it's hard to get away from, right? Our goal would be, with every fund, you want to have 2 or 3 companies like a Muse or a GoCardless or a Paddle or a Remote or a Travel Perk or whatever it might be. If you can get 2 or 3, I think the best VCs can do that, right? Just because the 1 in 100 is in aggregate. Actually, Accel have great track record, Index do, Bolton do, et cetera, but it's never going to be more than 2 or 3, and that delivers the kind of the outsized returns. Our goal would be to say, can we find a way to a 1x with everything else? You have to work really hard to do that, but I think that's really important, because there is a really good, healthy market for M&A and even listings, with moderate sized businesses. So, I think you can do it, but it's hard.
And the reason I asked about first the portfolio model perspective was because now you sit there as the operating partner, and I want to ask you, then how do you think about the time allocation? Where do you see, because you always hear this, well, the bulk of the returns come from the outliers, but actually the bulk of the work happens with that middle group, trying to figure out how do we get them across the line somehow.
Yeah. This is really just from my perspective, okay, in terms of, so my role and that of my team, we focus, I think of it more like a customer success function, right? To say, you've chosen us because we're going to help you do that. My predominant focus is the first 2 years. I'll meet with every new investment and I'll work with every single one once or twice a month for like 2 years. Now you can only do that just cycling off, right? So then you have to become more reactive and selective. Appreciate the fact that actually, even though we're doing that work, we're still a minority participant. You've got 200 people working for you, and I'm bowling up once a month, right? To say, hey, thinking about this is a really important topic, something I wanted to cover off with you. Have you thought about ABC, whatever it might be? And we're quite structured in terms of how we go about that, but just, shooting the breeze kind of like it's not just a matter of saying, just bowling up and saying, how can I help? But actually, so here are some things I think are really important. You don't have to do this, right? But my goal is if I can get a higher percentage to 10 million in revenue, to be honest, if they're getting through 10 with pace, there's a reinvention process. So I think we can step in there, still relatively limited engagement. When they get to 30, 40 million, we're not private equity. We're not majority owners. We're not directive. You have to accept that they can bring in the people to do this work. And that is, frankly, the most important thing. So I think about it early, right? Which is say, lay the groundwork, cover off those topics, talk about the inflection points, talk about the importance of adaptability, talk about the changes and different ways you're going to need to think about the business. Something that was really, really interesting that came out from the conversations, I really didn't bring this out in the report actually, because it's one of those things, we did a dozen interviews, did it over about 6 months. And it was only when I was reflecting on it, when I was in conversation with Matt Weller and Yop a couple of weeks ago, that nearly every single one of those companies with 100 million revenue has done so with low single digit market share. Now, on one hand, you might say, well, that's obvious, isn't it, Stephen? Of course they do. It is. But you can only achieve that, one, if you've identified a big TAM, but two, if you're incredibly focused.
Yeah.
Because you can't do it spreading yourself thin. So actually, they've come out, and the second thing that kind of informed this insight was when I asked the question, so what did you do differently when you got to 30, 40 million? It's mostly not a lot. We just doubled down. We focused. Now, you can't do that unless you absolutely know your ICP. You absolutely know the customer life cycle. You absolutely know how and why they buy and how you're going to sell. And so they've really created their own knowledge base that says, this is how we operate. They created that kind of system, if you like. And then the second thing that was really interesting out of this was none of them are stopping. And shit, if you've got 100 million revenue and you've got 1% market share, like someone like News has, why would you stop? They all, and so with the ambition point you were mentioning all earlier, none of them have any intention of getting off the bus. They want to build legendary, enduring companies.
Stephen, from that learning and also that you said that it was actually kind of obvious that they got to that 100 million off of a single digit market share. What does that make you think about the two things? Because I kind of see it as conflicting. We always ask about TAM in venture. We want to see a big TAM. And at the same time, we also like typically winner takes all markets. That's at least very much what used to be the playbook of venture. Tell me, how do you marry those two views?
Yeah. Well, I mean, they're all after a weird take. They all embody that kind of mindset. But if you're addressing a huge market, you've got to get pretty damn big to do that, right?
Yeah.
The winners do consume, and the natural state they all want to aspire to is a monopoly. When you get to massive scale, that's certainly the reality. But I think within their industries, they are entirely category defining. Even though someone like Muse might turn around and say, I don't know, 2% market share, they are still redefining that industry. I talk about them a lot because I know them very well. And so I don't see those things as being mutually exclusive. What's really exciting is that...
Well, maybe if I should just add one thing to it. So for the experienced practitioner, it might not be mutually exclusive, right? But for the observer from the outside, it does sound a lot mutually exclusive, right? How could you be like, obviously you get to 2% or 3%, whatever market share, and then you have 100 million ARR, and that's a great VC outcome. And on the other hand, we only go for winner takes all markets. Well, who are you with 2% then? So it's from this perspective that I think that we do have some dogmas in venture that are not always helpful. And I think we have some thought leaders in venture that are also espousing these in non-helpful ways, because incredible businesses can be built, and that's exactly my point, in things like what Muse do, that has absolutely nothing to do with if you don't take 80%, you're not going to win.
Yeah,
because a lot of founders are sitting there building their deck on the back of, well, I got to have a credible path to taking this bull market. Well, that doesn't make any sense.
Well, I mean, it's kind of bullshit, isn't it? Really, it's like each of these companies could be $1 billion in revenue, and still not be scratching the surface. Now that lends itself a really, really big question, which we're not talking about in the report, which is, okay, how do I maintain the independence to be able to do that? Because that's what most of them want to do. Not exclusively. I mean, there certainly will be some who will say, actually, that's not for me. But for many of them, they want to be, enduring greats of all time companies. Obviously, there's a survivor bias to that. It could be $1 billion in revenue and still be like 5% market share. When what Salesforce's market share is, but they're 38 billion, I think, in revenue. Yeah. Is that something like that? I may be making that up. But they're still not the market. They are the biggest by a long way, but they're still growing. I think you have to lean into the opportunities that are in front of you, right? And each one of them is thinking about, is the market big enough for me to build a really big company? And can I execute it in a really effective manner?
Yeah, I think that's a great point. And let's close the pod on that exact point. Stephen, thank you so much for joining me, and thank you for adding to the knowledge base for all the AIs out there.
It's a pleasure. And can I just add one thing? If anybody knows other private, independent, VC-backed companies founded in the last 15 years that are delivering more than 100 million revenue, I'd love to speak to them.
Amazing. Thank you for saying that, Stephen. We will,
Thanks, Andreas.
sure, we'll put the report in the show notes, of course. So anyone that looks at the list of the 23 and says, well, I know one that's not on that, then you can reach out to Stephen.
Yeah,
Thank you so much.
Thank you. Thanks, Andreas.
This was their finest hour.
Tear down this wall.
It's more than just an alliance. This is a union of values.
Let's start acting.